Well, who's there on the show? Well, I will not use the word old, but we've been friends for 25 years now. So I would say, and when a dear friend whom I've known for 20 years now. And see, we are such good friends that even clothes are matching. Same pinch.
Well, yes, Nikunj, it's been great knowing you. It's been 20, 25 years. So it's been a fantastic journey so far.
You have a reputation that when you come on air, you will give multi-bag advice. And the idea is what you give, they make money. That's a reputation you earned. So what do we start with? Market view or straight off to multi-bagger ideas?
I don't know about the multi-bagger ideas, but yes, I think, Nikunj, today's interaction could not have been on a better day there when truce has been announced, ceasefire has been announced. At least it puts to rest any of the kind of geopolitical issues or tensions which probably the market had. Got reflected a bit of that yesterday, but thankfully today we're back to pretty much like business as usual or back to normal. And it honestly augurs very well for the market. It augurs well for India. You've seen the reaction to gold prices, to crude oil prices. I think all of this, we seem to be getting into kind of an environment of moderate inflation, subdued inflation. That's traditionally been always been a challenge or a pain for India. So clearly, honestly, from a sentiment point of view and the emerging macro fundamentals, I think this is a great situation to be in now.
They say good news and good price rarely comes together. Are we reaching what could be called a peak of good news? Because frankly, there's nothing to really get worried about. Tariff seems to be getting settled. Interest rates have come down. Liquidity has increased. Promoter deals are back. What else could take the market higher? What could be the trigger? Because everything now what we wanted, suddenly you have it in front of you.
So yes, Nikunj, yes, from a pure macro and especially external macros, probably a lot of good news is out there. It's more about now what we do in terms of our own internal policy measures, economic reforms, and I'm not talking of the big bang reforms, but just a few things could pretty much further buoy not just the sentiment but also further lift up the fundamentals and contribute to earnings growth. I clearly believe something that we really need to look forward to and watch out for in 2025 is clearly going to be the GST 2.0. I mean, that's something which has been in the works in terms of enough of reports out there and the media that the government is looking to now take GST to the next level, whether it's in terms of cut in tax rates or whether it is in terms of rationalizing taxes or reducing tax slabs and ease of implementation, all of that. I clearly believe that that's something which is probably less spoken about, less appreciated, but I actually believe that's going to be very, very powerful. So that is one, and two is upping up the spend on infra. I mean, this financial year, the spend on infra was kind of pretty much at 3%, which was in line with what it was last financial year. But there is room for that to kind of go up. I clearly don't think we have seen any peak of spending on infrastructure till we get to at least 5 to 6% of the GDP, which itself is growing. So I probably believe that in the next few years, you'll probably see infra spend probably double or maybe even go even higher than that. So these are some of the things which will continue to be very, very big growth drivers. These are things which will basically encourage businesses to grow and expand. So on the whole, yes, I think apart from the global macros, I also believe our own domestic macros policy measures, there's still a lot of room for many things to happen.
Right, so sounding positive. Nilesh, hi morning. This is Nehi also joining in the conversation. When we interacted last, I remember you had a view on IT, wherein you said you were positive on the space. You also said that if Infosys corrects a further 10-20%, it would start looking like an attractive buy. Now, with everything that's been happening globally, especially since Accenture's numbers have come, is that challenging your view on IT at all?
No, I don't think, because ultimately, I mean, this is a space, especially the large cap IT, is basically just been growing in about single digit. I believe that for a growth market like India, where we have so many other growth options, unless you are essentially hugging the benchmark or want just basically the basic kind of large cap market returns, Honestly, I think as a bottom-up investor, you probably don't have, a compelling reason to be in large cap ITs. It might be a good place to hide when, there's enough correction and these are anyway very capital efficient companies and strong on governance as well. But beyond that, there is really nothing significant to kind of really look out for. So even in good times, they were growing in single digits. If the US economy were to get challenged, global economy were to get challenged, even trying to kind of grow in high single digit could be a huge challenge for the big IT companies. Of course, pockets remain in the mid cap, small cap IT space, where they are specializing in specific domains. Those kind of opportunities can remain, but otherwise, the big IT companies, the best is behind them.
Okay, and Nilesh, what about your view on the entire Alcobev space? You've been positive on that space. We've not seen much happen on that front as well. Are you still looking positive there?
Oh, absolutely. I mean, that's clearly been one of the strongest growth bastions that India has in the consumption space. Clearly, post-COVID, over the last 5 years, the whole wave of premiumization has caught on to the Alcobev space. I think Indian companies have been hugely successful in being able to launch brands which essentially have got well received by consumers. And Indian Alcobev companies are only increasing their relevance to an ever-growing consumer base in India. So I still think it's still early on. We are still very early on in terms of matrices like our per capita consumption. And individual players continue to kind of be on the journey of premiumization, which is driving their realizations, revenues, margins, cash flows. So I still believe that the sector itself, the category itself, still has many years to go.
But why is that category not doing well, Nilesh? Well, as a theme, it's logical. As an idea, it is safe. As a concept, these are good companies. But if one looks at even the grand old daddy, if I may use the word, United Spirits, it has not created wealth the way other stocks have created in the last 5 years.
So clearly, first is I think within the entire consumer space, it's probably United Spirits maybe over the last 3 to 5 years, and we own a few stocks in this space. So just a disclaimer, including United Spirits. So over the last 3 to 5 years, clearly United Spirits has delivered reasonably good returns. It's delivered returns which are ahead of a lot of the large FMCG or the large consumer companies, not FMCG, but the large consumer companies. So to that extent, I think it's done pretty well, not too bad, both in absolute terms and relative terms. But obviously, the homegrown players like Radico Khaitan, which we have been owning as well for a very long time, they have done exceptionally well. So yes, and United Spirits itself has been going through a lot of rejig in terms of its business strategy, its portfolio. It's kind of shedded its portfolio, what we call as the popular segment, and is now substantially a premium kind of a segment. So to that extent, I think this itself has basically taken some time. It's taken a lot longer for the business to now stabilize itself. But clearly, will it be able to grow substantially higher than the category? I don't think so, because its base is so large, its market share is so large. So the big boys, I think, will find it, or the big giants will find it very difficult to kind of grow at a substantially higher pace. It's obviously the homegrown ones which are going to do relatively better.
So Nilesh, from a 3-year standpoint, what is looking like a theme where whether it is a mid-cap idea associated with that theme or with that template, but you see a earnings visibility of 15 to 20% on a CAGR basis?
Yeah, absolutely. I mean, I think that's really been the segment where most of the tier 2, tier 3 companies across sectors have been growing at that kind of pace, whether we start with IT services or consumer or some of the cap goods companies. I think those are on a very broad-based basis, companies are growing in high teens, which is a great situation to be in context of where the economy is growing at 6-7% in real terms, 10%, 10 to 11% in nominal terms, and the earnings of the large companies or the nifty companies are probably at best growing in high single digit or maybe low double digit or the early teens. Versus that, clearly across sectors we see the next level of companies growing at significantly higher pace. So that's a great kind of situation to be in.
What about your view on financials? Last time you were very bullish on financials. They've seen quite the run up before geopolitical action took over. I remember you being positive on IDFC First Bank as well. Does that conviction continue?
Yes, I think across the board, financials, banks is a great place to be in. I think, of course, we all know that the balance sheet condition, I think, is amongst the best. We haven't seen balance sheets which are as strong. Clearly, the growth continues to be there, especially for some of the smaller banks, some of the specialized credit plays, and some of the other verticals within financial services, which have been growing extremely well, be it online investment platforms or online insurance distribution platforms or online payment fintechs. I think these are some of the categories or sectors or individual companies which have done really well, especially in the recent months or in the last 1 or years. So we continue to be very, very positive. Financialization of savings, financialization of the economy is not just a multi-year kind of an opportunity. I think it's a multi-decadal opportunity, and I believe it's one of the most strongest investment themes that India as a market has to offer to investors.
So what is a better idea? Stick to, let's say, stockbroking firms, or buy AMCs, or buy into intermediaries like NSC and CSDL, or it is time to go back to banks?
Believe it will have to be a combination of both. There is really no overlap. I think when we talk of banks, there are credit plays. Banks, of course, will benefit as long as we see the markets continue to be strong. That will continue to attract lots of capital. It's an easy place to deploy, significant amount of capital for managers. So to that extent, the big banks will continue to kind of do relatively fine. But more importantly, specialized credit plays will do very, very well. Clearly, with falling interest rates, especially NBFCs, HFCs, will continue to do very well. Smaller banks, again, have a strong possibility of outperforming, especially smaller banks which have built a critical mass. So this as a pack will do very well. And on the other hand, businesses which are linked to capital markets, businesses linked to online insurance distribution or payments as a space will kind of demonstrate growth rates beyond the 20-25%. So I would still believe that a portfolio approach works better. A combination or a bouquet of high quality franchises within the financial space, I think will continue to deliver market beating returns.
Nilesh, what about your holdings when it comes to the entire capital market theme? Angel One is a stock that you have been bullish on, but that stock has not done all that much YTD in the last 6 months. Do you continue to hold? And other than that, capital markets, what's looking good right now?
Yeah, it's probably actually done relatively well in the last 3 to 4 months after a sell-off that it had witnessed about 12 months ago. Clearly, a lot of the sell-off was based on a lot of the measures that were taken to bring slightly more kind of calmness in the derivatives market, and some of the other regulations which were introduced or policy tweaks which were introduced to ensure that capital markets become a more efficient and a more safer place for investors and traders. So I think as a reaction to that, some of the capital market oriented companies did kind of get impacted. But we clearly believe all that is behind us. Valuations are still reasonable, especially for the online investment platform. Just to talk about Angel One, yes, we continue to own it. We've been owning it for a long time and we intend to kind of keep owning it. Just to put things in perspective, very recently, Grow got valued by private equity players at a significant premium to essentially what some of the other publicly listed online trading platforms are trading at. So it just shows what long-term investors are looking at as far as this category goes, as far as this space goes. So to that, and I think it continues to make sense to kind of own some of the market-beating leaders out there.
So Nilesh, out of the core portfolio, which some is in public domain and some we've spoken about it, and please interrupt me if I'm wrong, you have names like IDFC Bank, Hitachi Energy, which has done exceedingly well for you, Radico Solar, United Spirits, Pratap Snacks. So that combination of, Daru and Chakna is there in your portfolio. You own private banks. Do you think the core portfolio could change significantly because of market conditions or because of valuations in the next 6-8 months, or you think this core portfolio will remain intact for 3 to 5 years?
I think these positions, we continue to be positive. Of course, obviously a right to reserve and to change the portfolio. So we continue to, as portfolio managers, continue to reserve that right. But I think, Nikunj, a few more opportunities look very, interesting. One, of course, is the whole digital space has expanded quite meaningfully. I mean, 2 years, 3 years, 4 years back, we probably just had, a couple of capital market plays or a couple of fintechs which were listed, or there were one or two, food delivery platforms which were there. But in the last 12 to 18 months, we've seen that bouquet expand quite meaningfully. And I think we continue to be very constructive on that space. We've been huge backers of digitalization as an opportunity. And we're clearly seeing a nice blend of financialization, urbanization, and digitalization. So this tripod clearly makes a great investment case. So we continue to be very watchful of digitalization and continue to look out for investment opportunities there. Number two is clearly defense. I think there is a very strong consensus that spending on defense is going to go up. And on top of that, indigenization or the indigenization related initiative is going to create strong tailwinds for many homegrown businesses in the defense and aerospace area. So that's a space where we probably don't have enough exposure, but clearly, and we've seen a very sharp run up. But if there were to be some kind of correction, this would clearly be a buy on dips investment theme. So that's basically the second area that we continue to essentially be very, very constructive upon. So these two are really the big opportunities that I could call them as the two Ds, which is digitalization and defense. These are two basically opportunities where we continue to be very, very positive beyond just the financials, consumers, or some of the infra and the cap good names.
Let's quickly get a disclosure, Nilesh. We've been very stock specific, regulatory, just for regulations here.
So we've taken a number of names in this interaction, Nikunj, and clearly a disclosure that we have a vested interest. We own these positions and these stocks. And so investors, viewers need to essentially do their own homework before acting on any of these stocks. These are not recommendations.
Good business, Nilesh, which is there on your radar, but prices are not great. Anything new from the recent barrage of IPOs, or anything which could be an offshoot of a large company, or any business which suddenly you think is reinventing themselves? I mean, you like the business, you like the company, but you don't like the price.
I would still think it's the whole digitalization area. I think there are at least been about a half a dozen names which have got publicly listed and have IPO'd themselves in the last 6 to 12 months. So we continue. I can't take any individual names right now on that because we are still kind of evaluating many of them. We continue to do our homework on them, and also probably are waiting for a bit of a correction. But that's really the space.
Nilesh, is it PB Fintech that you're talking about?
Sorry?
Is that PB Fintech that you're just talking about?
I wouldn't want to kind of get into individual names.
Well, Nilesh, everybody knows that you own PB Fintech. Why shy away from taking the name?
Yeah, PB Fintech. Sorry, PB Fintech is something we've owned, Nikun. Sorry, it's something which we've owned. I didn't get the question right. It's something which we've owned now for almost 3 to 4 years. So yes, and we continue to be very, very positive. We continue to be very positive on insurance. We continue to be even more positive on online insurance. So clearly, that's a great fit for us.
Don't be shy. Nilesh, if he owns the stock, he will give you the name and he will give you a disclosure. Don't be shy. He's a good friend. And he's always support the channel. So please ask him stock specific questions.
Sure,
Nilesh,
sure.
Am I giving the right advice or right mentoring to Snehi when I say Nilesh will always oblige the stock ideas?
As long as you give me the opportunity to make my disclaimer.
Shrishti?
All right, Nilesh, but other than that, Nilesh, if somebody really has to find value in this particular market, and especially in terms of the earnings projection, because in Q4, the earnings were a little better than what the street was penciling in, and some of the experts do believe that the earnings cut is what we can foresee in the next couple of years. Give us some sense that which sector are you closely tracking where you believe that the earnings upgradation could be at play maybe 2 to 3 quarters from now?
I believe the earnings upgrade is likely to happen across the board. Clearly, I think partly because number one, the global macros have turned better. Things like prices of crude oil, etc. I think have the potential to kind of boost margins as well as essentially lower inflation, leaving more money in the hands of consumers. So clearly, that's one reason. Two is basically the government spending on infrastructure, which was a bit tepid in the last financial year, is bouncing back. So clearly there's potential for essentially earnings growth to happen in this sector as well. Plus, obviously, these sectors will have the benefit of a lower base. So to that extent, optically, the earnings will look very, very good. But broadly, my sense is that still financials are the best position in an environment like this. That's really the space where I believe that earnings have the potential to kind of even get upgraded further from here on. So that's a very, very interesting space to kind of continue to watch out purely from the potential for earnings to get better.
Okay, and Nilesh, before we let you go, just want to get your sense on if there's been any change in stance from your end on pharma, because that tariff overhang still continues to be there, but we've seen some mixed earnings coming in from pharma. Has that changed anything for you?
Yeah, that's a difficult place to be. I still believe that the headwinds continue for that space. I know the street has been very bullish on some of the contract manufacturing plays, but we just don't think that they are probably the best in terms of capital efficiency yet. So we yet have to kind of come across a name which really excites us. But otherwise, I think pharma as a space continue to face challenges in terms of the regulatory or the impending tariffs, or even in terms of competitive intensity. Competitive intensity is going up. So in the very short term, with fall in crude oil prices, fall in raw material prices, margins have the potential to kind of do a bit better. But overall, I would still think the sector needs to kind of be kind of looked at with a lot of caution.
All right, Nilesh, with this, we let you go on that. So good having you on the channel today. Thank you so much for your time.
Thank you. Thank you so much. It's been a pleasure.